If you want to raise at your job, usually you have to go through the uncomfortable conversation of asking for it, and then you have to sell yourself all over again and justify why you think you deserve to be paid more, which is never fun, as opposed to investing in dividend stocks where they just give you the raise automatically. You don't even have to ask for it. And sometimes it's a pretty big raise, like 20% or so, like the one Target just announced, which we are going to be talking about in today's video. So without further ado, let's get into it. All right, what is going on, my friends? Ryan Williams here, back with another one. Here on this channel, we strictly talk about dividend stocks like Target, which has been one of the more talked about stocks lately, at least here on this channel and also in the Discord group. And they just announced a crazy 20% increase on the dividend, which is great for shareholders out there because it means that you're getting an increase to your ROI, your return on investment. And as we'll see in just a moment, this 20% boost on the dividend is way above Target's 5-year average dividend growth rate, which I think is around 8%, 8.5% or so right now. But at any rate, this is some of the best news we've heard coming out of Target for a while. And it's interesting because just a couple days prior to this announcement, Target came out and said that they were going to be lowering their guidance again, which is essentially an estimation of their upcoming earnings, how well they think they'll do. And they said they expect to take additional markdowns to remove excess inventory from their shelves and even cancel orders. Now, what does this mean here? So for those of us who are Target customers, it sounds like we may be seeing some bigger discounts in store, which is pretty sweet while they clear out their inventory. In fact, I was just there yesterday, guys, picked up some coffee, grabbed some cat litter, all the essentials. And you shareholders, you might want to spread the word, tell your friends and family to be on the lookout for those discounts at Target. Everyone loves a good discount and everyone loves a good dividend. Now, speaking of dividends, as I mentioned just a moment ago, this 20% dividend raise is considerably higher than the 5-year average growth rate, which is sitting at about 8.5%. So that's going to bring this 5-year CAGR up just a little bit, which is nice. And this dividend raise is also going to result in a higher starting dividend yield for this company right here. Now, in previous videos, I think in my live stream where I talked about Target, I mentioned that I'd be looking for maybe a 3% yield or so before actually investing in this company, which is sitting on my watch list. And prior to this dividend increase, for Target to get to a 3% dividend yield, it had to get to $120 per share. So it had to drop another, $30 from where it's at today. But now, guys, with this dividend increase, to get that same 3% dividend yield, Target share price only has to hit $144 per share. And it's, as you can see, it's like right there. But having said that, if you still have your sight set on that $120 per share for Target, that's going to put the dividend yield at a 3.6% yield, which is, almost 1% higher than where it's sitting at today. I'll tell you guys what, I wouldn't mind buying Target at a 3% dividend yield, but I would love to buy it at 3.6%, especially considering the rest of the dividend stats are looking really great. A 28% payout ratio, which is probably one of the reasons they're able to make such high increases to the dividend. Okay, the 5-year CAGR is still pretty average, 8.5%. We covered that. But the dividend growth history, guys, 54 years of consecutive growth. Target is a dividend king. Now, speaking about Target share price, I think one of the questions that we need to answer here is it a good buy today at its current levels, $150 per share? And just taking a look at its share price performance, year to date, it's down 35%. Okay, in the last month, a lot of these losses have come in the last month, down nearly 33%. And you guys might remember there was one day where they had a very substantial, like 25% drop, went from right here, actually, this was back in May, about $215 per share down to, $160. And it's been hovering since then, pretty much between $150, $160 per share. So personally, guys, talking about its valuation, Seeking Alpha gives them a C-. Okay, they have a PE ratio of 18, which is not terrible. Okay, this is still nearly 50% higher than the sector median and also 6% higher than this company's 5-year average. So I don't know. I don't think the valuation's bad, but what price would it have to get down to reach the sector median and also its 5-year average? So starting with the 5-year average, 16.97. Let's just crunch some numbers here. So 16.97 times its earnings per share, which is 8.59. I wrote it down on the screen right here. That would give us a share price of about $145, $145.77 if we want to be exact, which, as you remember, is about the same price, a little bit higher than the same price we would need Target to get to if we wanted a 3% dividend yield. So that's not too bad. Now, if we wanted to buy Target at the sector median PE ratio, so 12.2 times that same earnings per share, 8.59, that's going to give us a share price of $104.80, basically. Let's just call it that, which is quite a bit lower than where Target's at today. Do I think it could get down to, 104, 105? Anything's possible. I don't want to speculate. I don't want to predict here because I don't know the future. But to me, guys, that seems quite a bit low. I still kind of like that $120 price range for Target. So let's see what PE ratio that would put it in. So $120 per share divided by the earnings per share, that would give us a PE ratio of basically 14. That's not too shabby. Now, going back to the dividend raise for just a moment, guys, talking about maybe how to interpret it, I think this could be a sign of confidence from the company. They obviously realize they're going through these short-term issues, but they don't want us to forget, like, hey, we're still here, we're still a growing company, we're still going to continue to provide value for shareholders over a long period of time. And that's what we need to focus on as investors, is the long term, the business, how it's performing over a longer period of time. And, touching more on that, let's just go over to the financials page and dive into some quick metrics. So taking a look at this revenue chart right here, we can see at least since like 2019, it's been going up pretty steadily year over year, right? And the same is true with gross profit, guys. Same since 2019, going up and up and up. Net income, scrolling down, we're going to see a similar trend there, right? You can see that since 2019, maybe even 2018. And taking a look at the earnings per share, we see the same thing. Earnings per share is continuing to go up, although part of this could be a result of the shares outstanding going down because Target is buying back shares. So that could be pushing this earnings per share up. It's definitely having an effect on the revenue per share. I mean, look at that trend line since looks like 2016 or 2015, revenue per share just continuing to go up and up and up. So like I said earlier, guys, Target is still a growing company and they're still able to provide value for shareholders, both in terms of apparently shares outstanding, but also dividends per share. Look at this, going up every single year. And like we saw a few minutes ago, they have 54 years of consecutive dividend growth. So this is not Target's first rodeo. Now, having said all of this, guys, I'm going to continue to keep my eye on Target. I'd really love to invest in this company, and I'm really interested to see what the share price does in the coming months. And with that said, I want to hear from all of you guys. Do you think Target is a buy? Are you passing on it? What do you think? Let me know in the comments below. All right, guys, now with that behind us, let's get into the weekly portfolio update. I got to say, it was not a great week for me on the market. I mean, just today, as I'm filming, it's Friday, June 10th. I'm down nearly $600 just for the day, down 1.65%, which is a huge loss to see in one day. And it's brought my portfolio's market value down to $36,393.80, as we can see here, which compare that to last week, guys, we were sitting, a little bit prettier. The market value during the last update, we were at $37,479.70 with an unrealized gain of 8.27%. Compare that to today, guys, we are down to 4.5% for the unrealized gain in this portfolio, which just in the last week is a drop of basically 2.8%, which is huge. Huge loss, guys, but the silver lining here, there's two of them actually. Number one, it's making the stocks in my portfolio cheaper to buy, which is great. At the end of the day, we're buying the cash flow. We're buying for that dividend income. So in a sense, being able to buy stocks at more of a discount is going to work better for us. And having said that, it's helped me see a nice little jump in annual dividend income. So right now I'm sitting at just under $1,660, which is about an $8 gain this week compared to last week. And interestingly enough, too, this is right about where my annual dividend income was at right before AT&T reduced the dividend and spun off Warner Brothers into Discovery. Doesn't seem like a lot of time to recoup a lot of this income, and that's putting me at, nearly 83%. Let's see if we can square that. Nearly 83% of my 1-year goal of hitting $2,000 of annual dividend income by September of this year, which I'm going to talk more about this in an upcoming video, maybe in tomorrow's live stream. So stay tuned for that. I'm honestly not feeling too great about this income goal right now. I don't know if I'm going to be able to reach it, and I want to talk to you guys more about that. So stay tuned for the live stream. Now, getting into my purchases for the week, you can see I kind of switched it up for this week. I didn't buy any lows. Instead, I put $75 into Altria Group and bought 1.5 shares of that bad boy, which is something I haven't done for a while. And the reason I did this, guys, is because, just this week they're down almost 9% for the week. They had a really big drop from about $53, $52 per share, $54 per share, down below now where they're at, down below 50, which is great. It's like, I see an opportunity here. I might as well throw some money into it, build up this position a little more. So that was the first stock I bought. And then going back here, I invested another $75 into Starbucks and got 0.95 shares of that. Now, because my portfolio was so down this week, it's going to be really interesting to see what the best and worst performers are. And taking a look at this right here, the only stocks that were in the green for the week were Verizon and EPD, which those are defensive stocks as it is. So I guess I'm not too surprised to see those hanging in there. Chevron's not doing too bad. AT&T's not doing too bad. And scrolling down, seeing what the worst performing stocks are, geez. Okay, so I guess it's no surprise Altria Group was the worst performer, down 9.6% just for the week. Okay, Intel down nearly 8% for the week. I need to look more into that. But looking here, it's officially below $40 per share. That's insane. Southern Company also didn't do too hot, down over 3%. Procter & Gamble, Lockheed Martin, there's some good and bad here, but overall, guys, remember, it's about the long term. These red weeks, which I'm sure, a lot of you guys I know have some of these similar stocks in your portfolios. This just comes with the territory. If you're going to be a long-term investor, you have to be prepared for days and weeks like this where you're down, 1.6%. And that's just why I really want to reinforce this point. That's why it's so important to invest in high quality companies, ones that you understand, ones that you trust to be there for the long term, like the Coca-Colas, the Lowe's. Don't fall for those yield traps, guys. It is really about the business. And that's a quote that I just pulled from Dapper Dividends. I was listening to his podcast earlier today, and he touched more on that topic, guys, but it's so true. Anyway, guys, if you want to see more inside of my dividend stock portfolio, then click on this video right over here. This video is my most recent live stream where I talk about a particular dividend king I just sold out of in my portfolio. And here I explain, what it is and why it's not a good investment for me right now. So if you want to learn more about that, check this video right here, and I'll see you in the next one.